For years, we've been told a simple story. China cannot afford a stronger currency, that a fragile domestic economy needs exports, that the yuan must stay weak or everything breaks. But what if that story is no longer true? What if the real risk facing China today is not a weak currency, but a currency that is too cheap for too long? Because something has quietly changed. Markets are paying attention. Institutions are shifting their language. And pressure that once pushed the yuan down is now pushing it up. Not because Beijing wants it, but because the system is starting to push back. When trade surpluses grow this large, when the world's patience thins, when capital stops behaving the way policymakers expect, exchange rates stop being a technical issue. They become political. They become unavoidable. If you want to understand where China's economy may be heading next, this is the place to start. Stay with me. Because to understand why this pressure exists, we need to step back and look at how China got here. The question, then, is not whether China wants a stronger yuan. It's whether China can still prevent one. For a long time, the logic was straightforward. Domestic demand was weak. Exports carried growth. And a structurally weak currency made that model work. Net exports delivered a huge share of reported growth, too huge to ignore. So the assumption followed naturally. Beijing would always choose stability over adjustment. But that logic depended on something else remaining constant. The world's willingness to absorb China's surplus without pushing back, that assumption is now cracking. Trade partners are no longer looking only at China's current account headlines. They're looking at market share, at imbalances, at the strain on a global trading system already under pressure. And once the conversation shifts from numbers to sustainability, from economics to politics, the exchange rate stops being an internal choice. It becomes a shared problem. To see why this moment is different from the past, we need to look at how this surplus was built and why it no longer dissipates the way it used to. To understand this pressure, we have to rewind the cycle. After COVID, China did not rebalance toward domestic consumption. Instead, it doubled down on what still worked: exports. Weak household demand, a long downturn, and policy caution meant savings stayed trapped at home. And with a largely closed financial account, those savings had nowhere to go. So they flowed into production, into factories, into goods that had to be sold abroad. The result was an export boom that looked like strength, but functioned like a release valve for internal weakness. For years, capital outflows helped neutralize that surplus. Rate differentials favored the dollar. The yuan depreciated. Private money quietly left the country. That offset the trade imbalance. But cycles change. As depreciation slowed and expectations shifted, those outflows weakened. The surplus stayed. And suddenly, the pressure that once leaked out through capital flows had nowhere to go except into the currency itself. This is the point where a technical imbalance becomes a systemic one. And it sets the stage for the first real stress test. The first crack appeared not in Beijing but abroad. As China's export volumes kept rising, the reaction changed. What once looked like competitiveness began to look like imbalance. What once felt cyclical began to feel structural. Warnings followed. Trade partners started using stronger language. Imbalances were no longer manageable. They were becoming unbearable. At the same time, institutions that had long downplayed currency misalignment began to shift. The idea that the yuan was simply weak rather than undervalued lost credibility. Quietly at first, then more openly, this mattered. Because once the global conversation changes, markets listen. And markets don't wait for policy statements. Foreign exchange data began to tell a different story. Net purchases turned persistent. State banks stepped in, not loudly, but steadily. This wasn't a crisis with flashing headlines. It was a pressure build-up, slow, relentless, harder to dismiss. And if you're watching closely, this is the moment when exchange rate management stops being routine and starts becoming risky. If this analysis is helping you see the system more clearly, keep going with me. Because the real story isn't the pressure itself. It's how China is trying to contain it and what that reveals about the system underneath. On the surface, China's exchange rate still looks controlled. The yuan moves, but only a little. There are signals, warnings against one-way bets, assurances of stability, but underneath, a different mechanism is doing the real work. When private capital no longer flows out fast enough to offset the trade surplus, the system improvises. State banks step in, they accumulate foreign assets, quietly absorbing pressure that would otherwise force the currency higher. It's not called intervention, but functionally it is, and it works up to a point because the scale matters. The surplus is enormous, larger than what state banks can comfortably neutralize without drawing attention, and larger than what can be managed indefinitely without consequences. Here's the deeper problem. If nominal appreciation is capped at just a few percentage points, the real exchange rate doesn't adjust. Undervaluation persists, market share keeps rising, and trade tensions intensify, but accelerate appreciation too much, and a different force awakens. Latent demand for yuan from firms that park dollars offshore for years. This is the trap. Control invites pressure. Pressure demands more control, and the system tightens around itself. The next phase isn't theoretical. It's already forming, and it arrives as the second, sharper stress point. This is where the pressure accelerates. As expectations shift, behavior changes. Exporters hesitate. Traders reposition. Everyone starts asking the same question. What if this isn't temporary? Because if appreciation is slow but predictable, and there's even a small chance of a bigger move waiting, becomes costly. So bets begin to stack on one side. Foreign exchange settlement numbers start climbing month after month. Not in a single spike, in a grind, a steady accumulation that tells you something important. The system is no longer balanced. Authorities respond the only way they know how. More signaling, more warnings, more effort to convince markets the yuan is not a one-way trade. But credibility is fragile. Every intervention that keeps appreciation modest reinforces the belief that the currency is still undervalued. And every reminder of control highlights how much control is required. Meanwhile, state banks resume large-scale foreign asset accumulation, hundreds of billions annually, enough to matter politically, but still not enough to erase the underlying surplus. This is the second crisis point. Not loud, not dramatic, but more dangerous than the first. Because now, pressure isn't just external, it's internal. And that's when currency policy stops being abstract and starts touching people's lives. And this is where the story reaches you. Because exchange rates are never just lines on a chart. They shape decisions. They change behavior. They quietly rewrite everyday economics. If you are a Chinese exporter, uncertainty becomes a cost. Do you convert dollars now or wait? Do you hedge or gamble that appreciation stays slow? If you are a worker, the pressure is invisible but real. A currency held down sustains exports today but delays the adjustment that could support consumption tomorrow. Wages rise more slowly, domestic demand stays weak longer, and if you are a household, savings choices narrow, opportunities remain limited. Risk concentrates where policy allows it to. This is the human side of currency control. Stability that protects in the short term but constrains in the long term. And here's the hard truth. The longer pressure is suppressed, the more abruptly it can surface. If you've ever felt that economic systems move slowly until they don't, this is exactly that moment. Pay attention to this phase because what happens next doesn't stay inside China. It travels. Once China's currency pressure spills outward, the world feels it fast. A persistently undervalued yuan doesn't just boost exports, It reshapes global trade flows. Manufacturers elsewhere lose share. Political patience erodes. And we're already seeing the shift. Trade partners no longer frame the issue as a temporary imbalance. They frame it as a systemic distortion, one that strains a global trading system already tested by tariffs, industrial policy, and strategic rivalry. This is why the conversation around China's surplus has hardened, why reported current account numbers are no longer taken at face value, why attention is turning to the true scale of the surplus and how it's financed. At some point, currency policy bleeds into trade policy, and trade policy bleeds into geopolitics. Pressure builds for responses. Investigations, thresholds, retaliation, formal or informal, none of this requires confrontation to start loudly. It starts quietly, with reports, with language shifts, with rules being reinterpreted. And once that process begins, it's hard to reverse. This is the moment when internal choices become external constraints. To understand where this leads, we have to look ahead, not with certainty, but with scenarios. From here, China faces three broad paths. None are clean. All involve trade-offs. The first is the controlled adjustment scenario. The yuan is allowed to appreciate slowly, just enough to ease external pressure, not enough to trigger a surge of inflows. State banks intervene more, not less, to manage the pace. This buys time but doesn't resolve the underlying imbalance. The second is the stalled equilibrium. Nominal appreciation stays minimal. Real undervaluation persists. Exports keep outperforming. And trade partners respond not all at once, but incrementally through policy, through regulation, through political pressure. The cost here is not immediate but cumulative. The third scenario is the hardest to manage. Expectations break. Markets begin to believe a larger move is inevitable. Offshore dollars come home. Latent demand activates. Intervention has to scale rapidly to keep control. And suddenly, stability requires far more effort than adjustment ever would have. None of these outcomes are abstract. They reflect a deeper truth about semi-closed systems. Pressure doesn't disappear. It waits, and the longer it waits, the fewer good options remain. That's why the final question isn't about currency policy alone. It's about choice. This story, in the end, is not really about the yuan. It's about what happens when a system built for control runs into forces that no longer respond to signals alone. China has managed exchange rates before. It has absorbed pressure before. It has warned against one-way bets before. But this time, the pressure isn't coming from speculation. It's coming from structure, from a surplus that keeps growing, from a world that is less willing to adjust quietly, from expectations that are starting to move faster than policy. Old slogans can buy time. They cannot buy resolution. At some point, choices replace management, and choices reveal priorities. Will stability continue to outrank adjustment? Will control substitute for reform? Or will the system accept movement to avoid rupture? These questions won't be answered in a press release. They'll be answered in markets, in trade relationships, in how far intervention has to go to maintain calm. If this analysis helped you see the system more clearly, stay with this channel, because the next phase of this story won't be technical. It will be political, and it's already beginning.